Hey everybody, welcome to Martinis with Scott, episode 116, I believe. Just give me 1 second. I'm still making my notes for this show. Your dollar value. There we go. All right, Martinis with Scott, episode 116. Come on in live, ask some questions, or do so in the comment, or find me some other way. This is just our daily touch base here on February 22. And I hope you had a great weekend. We certainly did here, although we had some crazy weather. I want to talk to you today about the 5 stages of, or in my view, the 5 stages of startup funding or funding for high growth businesses, as distinct from funding traditional family-owned, multi-generational businesses that have been around for a while and are relatively stable, even if they have some growth. I'm talking about the startup, what people would think of as the venture capital model to funding, because there's stages to this that people need to understand. I've been on Clubhouse a lot lately, and I've been working with some other, working to improve some of our other social media posts. And as a result, I'm starting to see a lot of deals. And Amar says, hey there, Scott. Hey, Amar. Just talking about funding right now. If you have another topic you want me to address at the end, please do so. And so I'm getting a lot of deal prospects in, and that specifically is funding and a VC funding. And what I'm finding is people are getting hung up on the VC model, the whole Series A, Series B, Series C, angel investing, that sort of stuff, as if those are the only sources of capital, and they're not. So I thought I would just touch on that briefly today, maybe on our Thursday show. If not this week, then in a subsequent week, we'll talk more in depth about this. But here, let me just walk through what I see to be the stages of funding a high growth or startup business that's intended to be high growth. So step number 1, the first stage will be what I would call seed financing or a seed funding stage. And this could be, people might break that down into pre-seed and seed funding. And at this stage of your company's life, you're truly a startup. You're probably doing some market research to define what your target market is and the service or product that you're offering. You're looking at product development, or service development. What exactly am I providing to this market that I've developed? You're looking at your getting your IP development, which is not just patents, but it's a documentation of processes, branding, all that sort of stuff that turns into actual intellectual property, which creates value for your high growth business. And you're trying to establish some metrics, I would say, in this stage, whether that be recurring revenue or user base. And you've made some progress to doing that. You actually have some revenue, you have some users, and that whole part of the growth of a company is captured in this pre-seed to seed funding stage. Okay, and as you think about how you fund your business, it's really important to know what stage your business is in. Not so much in the word that goes along with that, being the seed or Series A or Series B or any of that crap, but understand the amount of money you're trying to raise, what the use of proceeds are. In other words, what you're doing with those funds. Okay, and in this case, the pre-seed and the seed phase, you're doing everything that needs to be done to get up to where you have some users of your product, or you have some recurring revenue, or what have you. What are the sources of pre-seed funding? Just broadly speaking, bootstrapping. Bootstrapping, should be your absolute number one thought in terms of how I go about this. How can I fund this myself, either as a founder investment of my time, or just not use any money as much as possible? Okay, so for example, I've been involved in the startup of multiple businesses over 20, 30 years. Never once, well, maybe once, but really never once have I ever gone to a third party and said, hey, can I borrow some money to get this going? And this is back when I didn't have any money at all. The exception would be Merchant Capital. When I started that in Ottawa in 1994, I borrowed $5,000 from my wife at the time to buy a printer, because printers were really expensive back in the day, and that's how little money I had. But apart from that, I always bootstrapped, and one way that I did that is I always provided a service day one that I could charge money for. So it wasn't just a product I was building. I had a service that I could charge for, start generating some revenue, get myself into the market. We've done shows with Rob Fraser of Endura Apparel. You can look those up on Martinis with Scott. He'll tell you that his first seed / angel investment was $20,000. That was the money that he raised to help get his sock company up and running. So you want to look at bootstrapping, which means try not to borrow any money, generate some service revenue, whatever you can do. You want to look to your own pocket and time investment, right? You want to look to family and friends at this stage, and you could raise that 20,000 like Rob. You could raise 100,000, a couple 100,000, somewhere through your family and friend network. And then you want to look at maybe a small crowdfunding would be a possibility here. And small angel investors. What's an angel investor? It's people probably in your local community, probably business people or someone on an online forum for angel investors. And these are people that will lend you 20,000 or invest 20,000, 100,000, some number around that range. And you can get a few of them put together, and then you get a little bit of money. And they like to be early pre-venture capital, so to speak, investors. And that's what angel investors do. Once you've hit that stage, where am I on time? I got to pick this up here. You move from your seed into your Series A. So this is after you've proved your concept. Now, I don't want you to get hung up on the term Series A, because that's just a productization of a venture capital service, if you can think of it that way. Again, I want you to focus on how much money you're raising and what you're using those proceeds for. In other words, what is the risk profile of your business to an investor? So at the Series A stage, you're going to go, you've already proved your concept in the seed, right? You've got a little bit of revenue, you've got some users. Now you want to push that forward. You want to refine your offering, and you want to grow the platform, and you want to turn this into a real business. Maybe you want to, if you haven't already, you want to secure your patents, have your IP protection in place if you didn't do that in the seed. And what are the sources of a Series A risk use of proceeds investment? Well, you can go to Series A venture capitalists at this point. There are venture capital firms that focus on Series A, depending on what jurisdiction you're in. You can go to a larger crowdfunding. There's still limitations on that, okay? But crowdfunding is maybe a good first step at this. Okay, and here's what people I find from the startup community just entirely miss all the time. A Series A is when you need to start thinking about strategic investors. What is a strategic investor? This is a person or company that is not involved, that is not investing in you for the financial benefit, but rather for the strategic benefit. I want you to think customer. In a B2B situation, I want you to think supplier. I want you to think competitor. I want somebody with a strategic ancillary offering that fits well with you. You can start talking to them at your Series A and look for a strategic investment where it's not just I invest $100 in your company and I want to return on my $100, but I invest $100, I want to return on my $100 plus I get this ancillary benefit. Here's an example. At Globex Extraction in the US, a processing facility for hemp. This is a startup that's about a year and a half in. If I were to put it into this 5-stage discussion, I would call it, we're at a Series A stage, somewhere around there. But I want to make a strategic investment in a CBD brand because I think I'll get a decent return on my money, but I also think branding is where the value is, and it locks in a supply chain for me. There's an example of someone thinking on the buy side as opposed to the sell side, which is what raising money is. But there's someone thinking about what a strategic investment might look like. In Series A, you can also look at larger angels. There's some angels that put in 20,000, 100,000 in a pre-seed environment, but then you could start looking at $100,000, $150,000 units up to $1 million units from 2 or 3 angel investors, and all of a sudden you've raised some real money. You should always continue to bootstrap. And at Series A, if you have your IP in place, there may be even a public shell transaction that could be done here. You could reverse into a shell. You can get some help from an investment banker because there's value in the IP. And instead of thinking of public markets as just an exit, you can think of public markets as a platform to raise money. And it's never too early to start talking about that. All of these things have upside. All of them have downside. You need to understand it. My goal here is to communicate to you that there's different stages to financing and there's more alternatives than just the VC world. Okay, move on to the next stage, being Series B. Again, I'm just using VC lingo here. Doesn't mean you should get hung up on that. You shouldn't. You should be thinking about the amount of money you need to raise, the risk profile, and what you're using those funds for. Think of Series B as just a bigger Series A. In Series A, you've already proven your success, and you've got a real business. Now you want to move into new markets. You want to double down on your marketing and branding and blow this thing up. You want to double down on your HR build up, bring a bunch of people in, maybe get some real estate, for your office building, that sort of thing. That's what your Series B is for. Is to take a real business now and to make it into a huge success from a valuation perspective. What are your sources of funds for Series B? Well, now you can move into Series B venture capital, which is sometimes your C, or almost always your Series A VCs that want to move into Series B, and plus some other Series B VCs. Strategic investors, don't lose sight of that. Public markets, don't lose sight of that. Series C, okay, is just a bigger Series B. Now you're a huge success. You've got a multi-million, billion market cap from a private company perspective. Now you're going to do one last big thing before your exit. The big thing could be, new geographic markets, an acquisition, something along those lines. The idea here is you raise a bunch more money at a really high valuation before you move to your exit, which is the final stage. An exit in traditional VC would be the IPO. Okay, and your sources at the Series C would be your existing VCs. And again, strategic. Don't lose sight of your strategic. And then your last and fifth stage, the way I've outlined this, would be your exit. What is an exit? This is more money coming in to continue and push forward your business plan to the next stage, but also to create liquidity for your early investors, for your seed, your A, B, and C investors. Well, they need to get out at a profit at some point here, and the exit is a start of doing that. What are your sources for the exit? Public markets and strategic. Everybody knows that, right? When they start their tech company, they want to either go public for billions, or they want to sell it to Google for billions, or whoever. And so that's a public and a strategic in the same sort of way. All right, what else do I have for you? How do you know what's important from this discussion? That there's stages that a company goes through between zero and billions of dollars of market cap, where people get rich and famous. There's stages, and the stages are tied to the risk of the business, the use of proceeds, as I've outlined, and the types of investors, how much money you're trying to raise, the types of investors that will go into this thing. That's it. I have to wrap things up. Hey, I'm on Clubhouse tonight, 6 p.m. Eastern. If you're on Clubhouse, come join us. We've got a great panel in our room, a discussion. Amar, do you have anything you want to ask before I hang up here? I got 1 minute before I have to go pick up my daughter at school. Nothing from Amar. Please subscribe, Martinis with Scott, if you like the content. Even if you don't, hit the subscribe button. Give me a thumbs up on YouTube. Helps a lot. We'll check in with you tomorrow. Take care.